You might notice as a radio station here in town, we do a lot of business with businesses and small businesses especially. So we get to actually interact with a lot of different organizations and those who are looking to grow their business. So what do you do when you need capital to expand? And also, what do you do about your debt? Is it all bad? Is it like cholesterol, where you have bad cholesterol and good cholesterol? Is debt like bad debt and good debt? Well, here to talk about debt and how it can actually help small business owners grow their businesses, Kenny and Sean Salas. Good morning from Camino Financial. Guys, it's good to have you back.
Good morning. Thank you. Good morning, George. It's a pleasure to be back.
Now, we always think of debt as a bad thing, especially in our personal lives. You don't want to have too much debt, although we understand in this day and age, sometimes you need at least to have some sort of debt that you can use to leverage credit on a personal level. But from a business level, you're really talking about the difference in good debt and bad debt and actually using it to leverage growth of your business. And tell me a little bit about that.
Yeah, no, thanks for the question, George. I would say first think of debt as a type of investment that you would make in your business. So whenever you raise capital and make an investment, you want to make a return on that investment. That means paying back the original investment plus a gain on that cash. And small businesses have several reasons to invest in their business. One is to fund working capital. Typically, cash gets tied up in the business and impedes them from taking on orders and making money on that. Another thing is buying assets, buying equipment, opening a new store. And a third reason that we see is just overall growth, potentially investing in marketing, hiring a new salesperson so that you can grow your business. Now, small businesses tend to tell us, well, my business generates enough cash. Why am I going to tap into outside sources if I have my own money? Well, there's really two reasons. One is every time you reinvest cash into your business, that's investing your own equity back into the company. So you're putting all your eggs into that basket. And you potentially want to think about de-risking yourself and tapping into other sources of capital. And the second reason that you should only self-fund is once you tap into the debt markets, you can actually lower the cost of your capital structure. So maybe the first type of debt you get is a credit card that has a higher interest rate. Once you build a track record, you can start accessing cheaper sources of capital. And you never know, down the line, you may need that $50,000 or it can be $200,000. And when you need that cash, and if you don't have a track record, I'm going to tell you, George, right now, it's going to be tough to get it.
It's very expensive, and that's kind of the principle, as they say, SEM, someone else's money, to be able to leverage your ability to build your business and get that back over time instead of, like you said, pulling all it out of your savings or out of your profit margin and pumping it back in. What type of debt instruments exist, and why do they exist? What purpose is there?
Yeah, no, so I would start with, I would say there's two traditional debt instruments out there. One is a line of credit and the other one is a term loan. The open line of credit or line of credit is used to finance short-term cash needs, and that is used for working capital. So some businesses are seasonal. They have certain months where their business is not generating enough cash, so they can draw on that line of credit. Very similar to a credit card, and you only pay interest on the debt balance that's drawn from that accessible line.
Yeah, I call that the financial accordion. Sometimes it's the air is all out, sometimes it's in, so you don't always have that even keel of dollars coming in. So it's good to have something that you can rely on.
Absolutely. And then the second debt instrument is called a term loan. I would qualify this more as patient capital. They really start at about 1 year and can range up to 10, 30 years, depending on where you're getting that capital from. You pay it based on an agreed term. It's usually a fixed schedule and at an interest rate that's agreed upon. There are several sources. The SBA, through commercial banks, provides government guaranteed loans, which are the lowest rate that's available to small business owners. And this is really used for long-term investments. So if you want to buy a new store, open a new restaurant, and you're expecting to pay that back over a 5-year period, a term loan is probably accessible to you. Now, George, there are other alternative sources of capital. One is called Invoice Financing, or it's also called factoring. And to the extent that you want to fund unpaid invoices, sometimes clients take more than 30 days to pay you back. And so you go to one of these specialty lenders, and they essentially give you that amount at a discount. So they'll be like, if you're going to get paid $100,000, I'll pay you a certain amount, and at the end of the day, I'll probably just take 2-3% of that invoice as my payment to myself.
Right, it covers you for...
Exactly. And then the third one, alternative source of financing, is a merchant cash advance. And essentially you get cash up front and you pay that back based on a percentage of your credit card or debit card sales transactions. And then and then you finish paying that until you pay the complete principal amount and the agreed upon interest. And that's really helpful for people that don't have the best credit and need cash very quickly. It's a very quick and simple process. And best of all, it's at a higher cost, but it helps build your credit. And so that's one way to think about it.
And it is the new year, so especially if you haven't gotten your business plan together or your financial plan for 2015, then you might already be behind the 8 ball, but you can actually get that together. If you're looking at your cash flow and seeing what you need to do, these are the guys to talk to, Sean and Kenny. Camino Financial, CaminoFinancial.com. Phone number 661-488-2206. A really good opportunity for growing your business, or even if you have questions about how to access capital that you need. You might not think about it, but yeah, you're right, because if something happens and you invest all your own money into your business and something comes up and changes, all of a sudden your cash flow gets affected. And that we saw that crunch happen just a few years ago. So it's very important to have that access.
Absolutely.
CaminoFinancial.com. Guys, thank you so much for coming in. Absolutely. And very, very informative and insightful.